All right, in this video, I'm going to literally show you how I get paid to buy shares of stock. And if you're interested in learning how you can get paid too, then watch this video. All right, let's just jump right into it. All right, everyone, Lee Lowell here from smartoptionseller.com. So we're talking about literally getting paid money to buy shares of stock. So what you see in front of you is a cheat sheet. We always pretty much use these cheat sheets in our videos. How to get people to pay you to buy their stocks. And the method that we do it, one of our favorite, selling put options right here. That's how you're going to do it. You're going to sell put options. And if you don't know anything about selling put options, or if you heard about put options and you're not sure how it works, literally people pay you for your obligation to buy shares of a stock that you choose and a price that you want to buy that stock for. Okay? It's an incredible strategy. So let me just move myself over here. This is one of the best ways to get potentially shares of stock that you want to buy. Now, if you've been a fan of investing for a long time, you know that probably the best way to increase your wealth over the long term is by investing in the stock market. The stock market has been the greatest wealth generator over any other type of investment, over real estate, gold, CDs, treasuries, whatever. Over the long haul, if you just plunked your money down into an S&P 500 fund, you're going to make anywhere from 7% to 10% per year over the long run. It's the greatest wealth generator. So if you want a way to potentially get into shares of stock so you can hold them for a long time and make a lot of money, you will want to learn how to sell put options. All right. So let's just talk about what put selling is all about. It is a 5-step process, and I've got it listed all right here in front of us. So we're going to talk about it. We're going to look at an example. I'm going to show you the numbers. I'm going to show you how much money you can get paid, and you're just going to love it. It's a 5-step process. So number one, pick a stock that you want to buy and that you feel bullish on. Number one, right out of the gate, you have to be bullish on a particular stock or a stock that you're interested in potentially buying. Think about if you had bought Apple, 20 years ago, Google 20 years ago. All these stocks have just skyrocketed and have made so many people so much money. So in order to get a stake, you have to consider a stock that you want to buy. However you manage to do that, whatever your stock buying process is, whatever your stock researching process is, you figured out a stock that you want to buy and potentially, and you're bullish on, okay? Now, number two, decide on a level that you would feel comfortable buying that stock. And this is what's called in the option world, it's called the strike price right here. So if a stock's at 100 right now and it's topping out, you think it's topping out, you don't want to buy it right then and there at 100, what level would you be comfortable buying that stock at potentially? $90 a share, $80 a share, $70 a share. You decide ahead of time where you would want to potentially buy that stock, and that's called the strike price. Okay, so number one, you found the stock. Number two, you figured out where you want to potentially buy that stock. Now, the third step is now you're going to look at the option prices, put option prices, not call options, put option prices in an option chain, and see, you're going to look at various expiration dates. I'm going to show you how we do all this. You're going to look at various different expiration dates for that strike price and see how much money you can get paid. Step 4, once you figured out which put option you want to sell and which expiration you choose, you're going to sell that put option and you're going to collect the cash from the other person. Step number 5, then you just wait until the expiration day to see what happens. If you want to wait that long, right here I got in parentheses, if you want to wait that long, because you can always get out of the trade before expiration. I just want to say that ahead of time. People ask me, Lee, do I have to hold the trade all the way to expiration? And the answer is no, you do not have to hold an option trade all the way to expiration. Okay, so there's your 5-step process. We're going to look at it. We're going to look at the stock. We're going to look at an option chain. I'm going to show you the numbers. Number one, do you get to buy your stock? That is a big question. Okay, the end game is that there's only 2 potential outcomes, and I'm going to show you why and how you'll get to buy shares of stock. But regardless of whether you get to buy the stock, you will always get to keep the money that you were paid for the initial transaction. Okay, so here's how it works. If the stock finishes above the strike price on the expiration day, you will not get to buy shares of stock. That may or may not be unfortunate, depending what you want, but you get to keep the initial payment. Number 2, if the stock finishes below the strike price, then you will be required to buy the shares of that stock make you very happy because that's the stock that you wanted at the price you wanted, and you will have to pay for those shares in full at that time. I'm talking about right here. And you get to keep the initial payment as well. And additional info down here, if you ever change your mind for any reason and you've sold this put option and you decide that you want to get out, you don't, for whatever reason, you don't like the stock anymore, you don't like the company, you can always buy that put option back well before the expiration date. Okay, and that could end up in a profit or loss depending on what the option price is going for at that time. All right, so let's jump into an example. I'm going to show you the numbers, show you the option chain, and show you how it all works. So number one, we're going to look at a stock, and we're going to look at Tesla today because so many people love Tesla, so many people are bullish on Tesla, and so many people think it's just going to keep going higher and higher and higher. So let's just assume for this situation, you are bullish on Tesla and you want to potentially buy shares of Tesla, but you don't want to buy Tesla at its current price of $426. It's hitting some highs. It's had a nice rally. It's getting overbought on the RSI down here. So you want to potentially buy shares of Tesla. And I say potentially because it's not a guarantee, but you will still get paid for your obligation. You want to figure out where would you be comfortable potentially buying shares of Tesla sometime in the future. Okay, is that at $400? Is it $350? Anywhere else down here, you're going to decide what would be a comfortable level for you. Now, the next step, I said, then you go into the option chain and start looking at option prices for Tesla. Okay, so for any of you that might not know, this is what's called an option chain, and this is where you see all the option contracts trading on a particular stock. We got put options listed on the right here, call options listed on the left. We're going to concentrate over here because these are the put options. I've got Tesla pulled up. Here's the Tesla tab. And the last price for Tesla, this is in the after hours. So I showed you the price around 426, trading at 425.5 in the after hours market. So we're just going to assume it's around 425, $426. So in your mind, you're thinking, okay, I like Tesla. I want to get bullish on Tesla. Where do I want to potentially buy Tesla? Now, these strikes, as I said, the strike price is the level where you decide you would potentially want to buy shares of Tesla. Okay, so Tesla strikes, in this case, okay, this is November 21st, 2025, expires in 62 days from now. So this is a 62-day trade. This is not a real recommendation. This is not a live recommendation, not investment advice. I'm just showing you the examples. So in this case, we're looking at November 21st, 2025. These expire in 62 days. And if you click on this More tab, you can see all these expiration dates. It goes all the way out to January 2028. In this case, we're looking at a 62-day expiration. Now you go up and down the strike prices. Strike prices go from 100 all the way up to 860. Okay, those are the strike prices. Now, with Tesla being around $425, $426, you're thinking, okay, I don't want to potentially buy it that high. I want to buy it at a lower level. So you have to decide what price that would be for you. So you scan through the strike prices. You're going to look at the bid-ask column because that's the most current price that these option prices are that these option contracts are trading for. And I'll show you how to read these things. Let's just assume that you want to get $500 for your obligation to buy shares of Tesla. Now, every option contract consists of 100 shares of stock. So when you sell a put option contract, you're obligating yourself to buy at least 100 shares of stock. One option contract equals 100 shares of stock. So right off the bat, you know that if you're going to follow through on your obligation, you're going to have to buy 100 shares of the stock at the strike price. So you need to make sure that you have money in your account to cover that. I'm going to talk about that in a little bit. So let's just assume you're looking to collect $500 from another person for your obligation to buy shares of Tesla at whatever price you decide. So in this case, you see $4.95 at $5.05 offer. You have to multiply these numbers by 100. That's the option multiplier. Each option contract consists of 100 shares of stock. So any number you see in the bid-ask column, multiply by 100, and that's what that option is worth in actual full dollars. So if we take something right in the middle at $5 per contract for the 310 strike, if you sell this thing for $5 per contract, you will immediately get $500 placed into your trading account. Now, once that happens, now you're on the hook to potentially buy shares of Tesla for $310 in the next 62 days. Tesla's at $425.50. You're obligating yourself to buy it for $310. That is a $115 buffer of downside cushion you have. Tesla has to drop by $115 per share by November 21st in order for you to have to fulfill your obligation and buy 100 shares of Tesla for $310. If that comes to fruition, if Tesla actually does fall down to $310, you will have to fulfill your obligation. Someone's going to sell you their shares of Tesla to you for $310 per share, and you will have to pay $31,000 for those 100 shares. Okay? When you originally sold that put option, Tesla was at $425. If by some miracle Tesla falls down to $310, you get to fulfill your dream and buy 100 shares of Tesla for $310. Let's go back to the chart here for a second. Tesla's at $425, $426. $310 is all the way down here, okay? Somewhere around this level is $310. So you're thinking, okay, well, Tesla's going to have to drop all the way back down to this, area of where it traded for a while. And if you get to buy your shares, now you get to hold them for the eventual rally back higher. So now you have unlimited profit potential. If you get to buy the 100 shares, now you can hold those shares for the next however many years you want to hold them for. And if Tesla keeps going up above $310, then you're going to be making money. All right. Let's go back to the option chain here real quick. So what you can do is go through the option chain. If you want to go out to December, the longer out in time you go, the more money you will receive. So let's look at the December, just 1 month later, those 310 puts are now trading for or worth, let's see here, wait for the numbers to pop, about $750 you'll get. You'll get $750 in your pocket for your obligation to buy Tesla for $310. And the reason why these are more expensive, because you're giving Tesla another 30 days to potentially fall down to your strike price. Now, if Tesla never falls that far, then you just keep your $500 free and clear. You don't have to do anything else, and you move on to the next trade. And then you figure out another put option to sell further down the road, and you can wash, rinse, and repeat. If Tesla doesn't fall that far, you just keep selling another one. And if it doesn't fall that far for that expiration, then you sell another one. So you can see how much money you could potentially make by selling these. And these are what's called out of the money put options. Strike prices are out of the money. That means the strike price is currently lower than the current price of Tesla down here. That's called out of the money strike. Now, if you look, let's go down to these lower strikes. Let's get rid of that for a second. Let's look at the price of the 150 strike puts. Okay, these are worth 60 cents per contract. So if you sell one, you'll get $60. A lot less money, but Tesla has to fall a hell of a lot more, down to $150. Let's look at the chart again. Here's Tesla at $425. You sold a 150 strike all the way down here. So you're not going to have to buy shares of Tesla unless and until it falls down to $150. It may never fall that far ever again in our existence. We don't know. But you're putting out your obligation to let someone else sell you their shares to you for $150. And for your obligation, you're going to get $60 in your pocket. All right. So let's go back to the cheat sheet here and talk about, what do you have to do to be able to sell these put options and start collecting money? Now we scroll down here. Okay. Now we do want to talk about risk. Okay. You always want to talk about risk when you have any investment and money on the line. Losses can occur. There's no question about that. If you end up buying the stock, in this case, $310 that we're talking about, it could keep dropping in value. Tesla could keep dropping down to $300, $290, $250, $200. You're on the hook to buy it for $310 a share. So no matter what type of investment you get in, there's always a chance that the stock could keep dropping. So you have to keep that in mind. There's no guarantee here, okay? But if you're making your assessment that Tesla, you want to get long shares of Tesla, then you have to take the good with the bad, and the bad is that the stock could keep dropping. Now, you manage that risk as you would with any other type of investment. Let's just say you bought Tesla shares at its current price, or you bought Tesla shares 2 years ago, whatever. What is your risk management plan? That is different for everybody. Do you have a stop loss in place? Is that stop loss based on the stock breaching a certain support level? Is that stop loss based on you giving up 25% of your investment? Only you can decide. So do have some kind of risk management plan in place. The other thing is that if you want to be able to sell put options like I'm teaching you right now, you have to have a brokerage account, and you have to be enabled and approved to sell what's called naked put options. And that's just a term that means that you're just selling a put option contract with no other hedge or protection against it. It's a naked put, meaning if you have to buy Tesla for $310, you have no protection against that other than you putting in your own stop loss. Okay, so you have to get approved to sell naked put options with your broker. And there's two kinds of accounts that you can sell these put options in, either a cash account or a margin account. Now, there's no free lunch, okay? When you sell these put options and collect your $500 in the case of the 310 strike puts, you know that eventually, at some point, you may have to come up with $31,000 to buy those 100 shares. So your broker's not just going to let you just sell all these put options and collect all this cash and not have any skin in the game. The broker's never going to let you do that. So when you sell a put option, your broker is either going to have you hold aside. If you use a cash account, your broker's going to keep $31,000 of your free cash on hold that you will not be able to use until the trade plays out until the expiration date. So if you're trading in a cash account, you have to have $31,000 of free cash available sitting in your account ready to go at all times in case you have to buy the shares of Tesla. Now, I don't like trading in a cash account because I think that's an inefficient use of your money. You don't know if you're going to be buying Tesla at $310 a share. You have no idea whether Tesla is going to fall that far. So why would I want to keep $31,000 on hold, not being able to use it until expiration day? I think that's just an inefficient use of my money. So I like to trade in what's called a margin account. Okay, in a margin account, your broker doesn't make you keep that full $31,000 on hold. They make you keep a fraction of that amount. And depending on which strike price you choose, it'll be even less of a fraction. Okay, I'm going to show you how that works in the brokerage in the option chain in a second. So whether you trade in a cash account or a margin account, you do have to have some money held aside off limits until the trade plays out. And like I said, there's no free lunch here. You got to have some skin in the game. But regardless, you're still going to get that $500 or whatever strike you sell. You'll still get that money up front. That gets deposited into your account. So it's added into your free cash, and then some of that free cash gets held aside. Now, let's go back into the option chain here, and I'll show you what that margin requirement would be if you use this in a margin account. So let's go back to November here. And let's just assume we're going to look at these 310 puts. Okay. Now, in order to find out what the margin requirement is in this broker's case, we want to set up a fake potential trade. Okay. So let's get rid of this one, discard. So we're going to potentially sell this one contract of the 310 put for $5 per contract, which is you'll get $500. Now, in order to see what the margin requirement is, we're going to check our margin. Now, this is, in your brokerage account, you may get a pop-up box like this right before you actually execute the trade. And this is telling you you're going to sell one contract of the 310 put. You're going to try to get $500 for it. Over here tells you the money situation. Okay. And this is a fake money account. This is a paper trading account, which I highly suggest everyone getting. Most brokers have a paper trading account in addition to the regular account. Lets you practice without using real money. Okay. So here, your current situation, there's $1.17 million in this account. There's no margin at this point. But if you're actually successful in selling this put option, you're going to get $500 minus whatever commission. So $498 net you'll get. And here's how much money you're going to have to hold aside. $12,602. Here's the change, $12,602. Here's if the trade gets executed, you have to hold aside $12,602 out of that full $31,000. Okay, so let's just look at the numbers here. Let me calculate how much that is. So 12,602 divided by 31,000 is about 40% of that full amount. Okay, so instead of holding 31,000 aside, you only have to hold $12,600 aside. Okay, that's for the 310 puts. Now, if you were to go further out of the money, use one of these lower strikes. Let's just assume you wanted to sell the 250 puts. Now let's go down to the 210 puts. We'll go another $100 down, giving you cushion. So that thing you can maybe sell for $100. So let's put in an order here. And we're going to try to sell this thing for, let's say, 97 cents per contract. That would give you $97 in your pocket. And the margin requirement here, it's much smaller, $4,392. So that's out of the 31,000. So let's look at the numbers here. $4,392 divided by 31,000. You're getting like a 76% discount. Okay, it's only 14% of that 31,000, 14%. So you're using 76% less of your free cash if you use this in a margin account. Still, if you're using cash account, in this case, you'd have to hold, I'm sorry, this would be $21,000. Let me rephrase that. I'm sorry. I want to use the right numbers here. So $4,392 divided by $21,000, because it's a 210 strike, you're using about 21%. So you're getting a 79% discount on the free cash that you'd have to hold aside. All right. Now, a lot of people ask me about, well, what kind of return can I get? How much? I mean, I'm using my money for something. I have to hold aside this cash. What kind of return can I get? So in this case, this is how you figure out your return. If you sold this put for $97 and Tesla didn't fall all the way down to $210, you get to keep the full $97. And you had to put up $43.92. So here's how you figure out what's called return on margin. $97 divided by $43.92 equals 2.2% return in 62 days roughly. Okay, so that's about 2 months. 2-month hold time, you're getting 2.2% return. If you want to annualize that, times that by 6, and you're looking at a roughly 13% return on your money for this trade. Now, that's just if the trade expires worthless and you get to keep the $97. You got your 2.2% return for those 60 days. But just think about this. If you did get to buy Tesla for $210 and now you get to hold on to it for forever, now your future returns could be astronomical. So don't just think by selling put options, your only potential return is if the thing expires worthless and you only make the $97. You got to think in terms of, well, if I do get to buy the shares, then I could hold on forever. And now I have unlimited profit potential. All right. So that's something to think about. Now I want to show you, let's go back to the cheat sheet here. Now, if you decide that, you don't even want to buy the shares, you don't want to pay out $31,000 to buy Tesla shares, but you are interested in collecting the cash because you've now figured out a way, hey, I can make some money. I can sell put options. My advice is to stick with selling out of the money strikes. Okay, if you have no desire in potentially buying shares of the stock, you better give yourself a lot of downside cushion because the stock could drop for some reason. You never know why a stock could drop. So you want to make sure you use the out of the money strikes because that way the stock's going to have to fall even further before you even have to fulfill your obligation. All right. So those are the things that I wanted to tell you about. So you can get people to pay you to buy their stocks. And you decide, you're in the driver's seat. You decide the stock, you decide the strike price, which is the price where you want to buy potentially shares of that stock. Now, I want to also show you how you can figure out, what kind of probability can Tesla fall that? Is there even a probability of Tesla falling that far? So let's look at some numbers here. Let's put in $426 for Tesla. Now, this is a probability calculator. We have this on our site. You can take a look at it in the services tab here. I'll show you afterwards. Future date is, we're looking at the November 21st. That's 62 days ahead. And the volatility for Tesla, this is a percentage number. Now we can go right on the option chain and look for that. We're going to use the at-the-money volatility, 59%. So we can do that here, 59%. And we want to know how the chances of Tesla falling down to $310 in the next 62 days based on these inputs here. And click on go. So here's what it's telling us. Box here, box here. There's a 9.5% chance that Tesla could actually fall that far, all the way down to $310. Conversely, there's almost a 90.5% chance that Tesla will not fall that far. Okay, 9.5% chance. So as the put option seller, this is giving yourself an over 90% chance of winning on the trade. And by winning, I mean having the option expire worthless. Now, if the option expires worthless, you do not get to buy shares of Tesla at $310, but you keep your $500. And as I said, then you can do the same trade for another expiration date. Now, if you want a quick little way to see what the probability is, you can always use the delta. If you have the delta column in your option chain, delta, one of the definitions of delta also can tell you what are the chances of a stock falling to that level by expiration. And if we look at the 310 strike, it's about 8.6%. This is a percentage number, 8.6%. In the probability calculator, we were getting about a 9.5% chance. So the option chain's probably using a little different numbers in the background than the calculator here. One says 8.6%. This one has 9.5%. So it's a very little chance of Tesla falling that far. But if it does fall that far, you can be happy that you get to buy shares of Tesla at the strike that you've chosen. All right. So that is the lesson here. That is how you can get people to pay you to buy shares of their stock. If people, let's just say someone bought Tesla for $10 a share, way back when, and they have a stop loss of, I'm getting out if Tesla falls down to $310. Well, you'll be there to catch their shares of stock from them. That's how it works. These are the people that are going to sell these things to you. They want to get out of their stock shares at some point, but you have no position yet, so you're willing to step in at $310. So that's how put selling works. It's a fabulous, fabulous way to get paid money up front to potentially buy shares that you want. And if you don't get to buy the shares, then you just move on to the next trade. Now, just remember, if you do have to fulfill your obligation, you got to come up with the money. And your broker, as I said, is going to make you keep some money aside while the trade is active. And you have that risk management. You got to decide, when it may be time to get out of the trade. If you don't like Tesla anymore after you've initiated a trade, all you have to do is buy that put option back for whatever its price is at that time. And if that price is higher than the $5 that you originally sold it for, let's just say it's trading for $6 at this point, you're going to lock in a $1 or $100 loss on that trade. Or if it's trading at $4 and you buy it back for $4, now you're going to make $100 net. Okay, so it depends on where it's trading at that time and where in the expiration cycle you've decided to get out of the trade. Now, that is an intro lesson to selling put options. If you want to learn a lot more, if you want to take a deeper dive, you can go into our video series here. Let me refresh this page here and show you, close out this. We have our video series right here. If you want to take a deep dive into what put selling is all about, why it works so well, just go a lot deeper. And if you want to join us 30 days free for our newsletter, where we actually sell these put options and have access to the probability calculator, take a look at the video series and you can decide what you want to do with it. All right, that's all for me today. I hope this has been helpful. Make these free videos for the trading community. Please give me a like, share it with your friends, leave me a comment, send me an email down below in the description. I've got links for books and websites and software. And on the screen here next, I'm going to put another video on the screen, another video about put selling for smaller accounts. All right. So take a look at that if you want. All right. That's all for me today. I'll see everyone in the next one. This is Lee Lowell signing off.